And we are going to leave you with this. The closing numbers on Wall Street. BlackBerry. Oh, too bad Rochelle is not here for us to talk. The Dow closing the day up, just barely eking out gains, 3 points, and the S&P up 0.7%, while the NASDAQ, Jared talked about, big names, Alphabet and Microsoft, dragging it down 2% on the day. For a closer look at the broader markets, let's bring in Jake Jolly, BNY Mellon Investment Management Senior Investment Strategist, and Keith Fitz-Gerald, Fitz-Gerald Group Principal. Good to see you both. Keith, we'll give you first crack. What's your interpretation of the day?
Well, interesting day. I think that investors are grasping at straws, i.e. the Mobileye, debut, but at the same time, they're shellacking companies that in the scheme of things really don't deserve it. So to me, it's interesting. We did a little bit of buying. I don't want to look a gift horse in the mouth.
Jake, what do you think about today's moves?
Well, I think we're still up over the last couple of days, and we're still positive for the month. But I think, unfortunately, the macro outlook has not materially changed. So we shouldn't be too surprised to see sort of the growthier tech side of the market come under pressure and remain under pressure so long as the interest rate outlook is still leaning to the upside.
Keith, we've had 24 hours now to let the earnings come in from both Alphabet and Microsoft. And let's start with Microsoft. Is there opportunity there given the takedown?
Well, no question in my mind. This is one of the strongest companies on the planet. It's one of the most widely held companies on the planet. It's up 1,400% over the last 20 years. It's up hundreds of percent over the last 5. Do you really want to get off a winning horse in the middle of the race? That's what investors need to think. And frankly, if a report like today where they had a double beat, top and bottom line, bothers them, they really ought to rethink why they're investing in the first place.
Jake, when you take a look at today's risk-off sentiment, S&P is still off nearly 20% since the start of the year. A lot of this has to do with fears here that we're going to slide into a recession. Where do you stand on that? And do you think the U.S. can still avoid a recession?
Well, we do think it is possible that we avoid a recession. We don't think that's the odds-on bet. We would give it about a 30% probability of avoiding getting some sort of a softish landing here in the next 6 to 12 months. But the other side of that probability, the 70% probability, is that we do have a recessionary environment. There are still a lot of indicators out there suggesting that there is more pain ahead in 2023. So for us, that means that this is a market that is starting to look much more favorable to bonds than equities. And within equities, we think it makes sense to be defensive and really favor those higher quality names within your equity allocation.
Keith, can we avoid a recession?
I think we've been in one for the past 6 months, frankly. I don't think the official statistics reflect that. The average American is hurting. The wallets are hurting. Everything's getting pinched in the wrong direction. And I think the Fed statistics don't just simply catch up. They're reflecting an economy that no longer exists.
Jake, we're 1 week out now from the next Fed decision. It sounds like 75 basis point hike is pretty much a sure thing. What are you expecting? And also, what do you expect then looking out into December?
Yeah,
well, I tell you what.
Go ahead, Jake.
I'm sorry, go ahead.
I think 75 is pretty much in the bag for next week. What we're obviously going to be listening for is an indication of whether we're going to get a downshift in the rate of hikes coming into December. Right now, it looks like the market's kind of debating whether we're going to see 50 or 75 come December meeting. Now, keep in mind that we get 2 more inflation reports before the next Fed meeting in December. So we're obviously going to have a lot more inflation data that's going to influence whether the Fed decides to step down to 50. We obviously saw the Bank of Canada deliver a surprise downshift today. I don't think that's really going to be influencing what the Fed does, but we got to see how these inflation reports come in before we can really see how the Fed's going to decide to take policy in December.
Keith, you were chomping at the bit to get in on that. So what's ahead from the Fed, and do you think we'll see in these 2 months any sign of inflation cooling?
Let's tackle the last one first. I don't think inflation is going to cool, not at the retail level. We're certainly all going to get pinched. But when it comes to the Fed, I don't think the Fed understands the narrative. I think it's as wrong now about rates and labor as it has been about transitory from the very beginning. So I'm hoping they're going to pivot. I'm hoping they're going to take a breath. But, 75 basis points is baked in twice. So I don't think that's actually going to happen. Traders with real money have a very different viewpoint.
So, Keith, what is it going to take then in order to see inflation start to cool?
That's the question I've been asking myself and anybody else who is going to listen for a long time. I think we got to fix the supply chain. The Fed simply got to go along for the ride until the government stops spending money, because you can't add fuel to the fire and expect different results. And that's what's been happening.
Well, divided government will assure that they stop spending money. So, Jake, what will help?
Well, unfortunately, we need to see some softness in the labor market. The Fed is facing a very strong aggregate demand. I disagree respectfully that we are in a recession right now. I think when we look at the economy, we're still seeing a very robust, economically active economy. And that's the reason that wages are still growing at 6%. And that is a problem for a Fed that is trying to get inflation back down to 2%. They're going to have to keep at it, as Jay Powell has said, keep tightening the screws on this economy. And that's what makes the outlook so challenging into 2023.
All right, got to get both of you to weigh in on this, because we're taking a little survey over the next hour. You're going to pick a FAANG stock, only we're going to take out Netflix. We're going to put Microsoft in. You're going to pick one stock next 3 to 5 years. Keith, you get one. Who you got?
It's got to be a FAANG.
It's got to be a FAANG, only we're taking Netflix out and putting Microsoft in.
Yeah, let's see. I'm gonna use A for Apple, believe it or not, and it's not FAANG, but I'm going Apple. That's the one I want to own in 5 years, bar none.
Jake, who you got?
I want to buy all of them, but if you're going to force me to pick, I'll take Microsoft.
Keith, when you take a look real quick outside of some of those tech names that we've already talked about, where else are you seeing opportunity in the market?
Tremendous opportunity in energy. That battle's a long way from over, both literally and figuratively speaking. Medicine is interesting. That's not going away anytime soon. Those are areas we're keen to look at. And finally, corporate security, literally digital security. With the number of bad actors around the world today, that is a must-have theme, and about as must-have as it gets.
All right, Keith Fitz-Gerald, Jake Jolly, thanks so much for joining us.